As an investor, the thrill of potential gains often comes hand in hand with the fear of potential losses. While fortune does favor the brave, savvy investors know that calculated strategies often trump blind courage. This is where the concept of the stop order comes into play, often touted as a protective shield in the realm of crypto trading. But what exactly is a stop order and how does it work? In today's episode, we will uncover all there is to know about stop order and how it can help you become a better trader. Hello and welcome to Bitcoin Scramble, your go-to source for everything related to the fascinating world of cryptocurrency, brought to you by B2B InPay. Have you ever been on a roller coaster, feeling the adrenaline rush as it climbs up a steep track, then bracing yourself for the swift and terrifying plunge? Investing can feel a lot like that. But what if you could set a safety net for that drop? That's where terms like stop loss or stop limit order come in. They belong to the stop order family, the financial world's equivalent of a roller coaster safety net. Think of a stop order as a command sent to the market to buy or sell an asset once its price hits a certain target, known as the stop price. This way you can either limit your potential losses or secure a certain level of profits. Let's say you own a certain stock or piece of cryptocurrency, but you have a hunch its value might tumble. With a stop order, you can set a predetermined selling price. This means you either cut your losses before they grow too large or secure your profits while they're still in the green. Stop orders are like your personal trading assistants. They keep a watchful eye on the market even when you can't, allowing you to buy and sell without having to be glued to your screen 24/7. By incorporating stop orders into your trading strategy, you can automate much of your trading activity, avoid costly errors, and curb risks. If you're not the kind of trader who relishes monitoring the market around the clock or fretting over the optimal buying or selling moment, stop orders are your secret weapon for setting your strategy on autopilot. So, how does it work? To set a stop order, you need to first have a target price in mind for a specific asset. The stop order sets a trigger price that, when reached by the market, will activate the market or limit order. Market orders are fulfilled at the nearest available price. Limit orders are activated at a specific or better price. So, let's say you have one Bitcoin, which you bought for $20,000. Right now, it's worth $24,000, but you're concerned that the price might go down. You can set up a stop order at $22,000. This means if Bitcoin's price drops to $22,000, your stop order gets triggered and your Bitcoin is automatically sold at that price. But it's important to know that a stop order is not a guaranteed sale at that exact price. Sometimes, if the market is moving very fast or there isn't enough demand, you might get a slightly different price than what you set.
This is something that happens in the markets. It can always happen, it will always happen, there's nothing anyone can do about it. What we have to do is make sure that when these stops do get slipped, we dust ourselves off and trade again. It will always happen throughout the markets and there's not really much we can do about it. It doesn't mean you should never not place a stop though. Stops and limits are the most important part of trading. Without stops and limits and risk management, it's very easy to blow your account out.
There are different kinds of stop orders, each with its own specific use. Using stop orders can make trading easier by automating some of the decisions based on your comfort levels. Let's take a look at some common ones. Stop loss order. A stop loss order is a bit like setting an alarm. Imagine you're not going to be around to watch the prices, but you want to make sure you don't lose too much if the price drops. You set a stop loss order below the current price. If the price falls to that level, your asset is automatically sold, helping you limit your losses. Stop limit order. Think of a stop limit order as a two-step process. Once the price hits your first target, the stop price, your order becomes active. But your asset is only sold if it can be done at your second target price, the limit price, or even a better one. Trailing stop order. A trailing stop order is a bit like a safety net that moves with your asset's price. You set it up as a certain dollar amount or percentage below the current price. If the price goes up, your safety net moves up with it, keeping the same distance. But if the price drops, your safety net stays where it is and will trigger a sale if the price hits it. Sell stop order. A sell stop order is used when you want to exit a position you hold. It's similar to a stop loss order, with a target set below the current market price. If the price falls to that level, your order is triggered and your asset is automatically sold. Navigating the investment world requires managing and understanding the risks involved. This is exactly what stop orders are designed to do. They help lock in your profits within a specific price range and cap your losses when the market isn't favorable. They foster a more balanced and prudent approach to trading. However, stop orders aren't a magic bullet. They're not completely foolproof, especially in the rough seas of the crypto market where prices can swing wildly. This can sometimes result in your stop orders activating at prices different from what you had set, an occurrence known as slippage.
When you're looking and you're adapting and learning how to place a stop loss and create that circuit breaker for your account, there will be periods where you feel that you've been stopped out, or you see that you've been stopped out of the low, and you lose faith in those mechanisms. It's something that you'll have to get used to.
Nevertheless, stop orders can be a valuable component of your investment strategy. By defining exact prices for buying or selling your assets, stop orders essentially streamline your trading process, removing emotion from your decisions. But like all strategies, understanding stop orders and doing your research is crucial before incorporating them into your trading strategy. That's it for today's episode. Thanks for watching. Don't forget to subscribe to our channel to stay informed and up to date with Bitcoin Scramble, brought to you by B2B InPay.